In 24 hours, crypto added $280 billion in market cap. Bitcoin jumped nearly 20% in a week, XRP surged almost 30%, and the entire thing was triggered by one announcement from the US Treasury about government bonds, not by anything happening in crypto itself. Now, analysts are split down the middle on whether this is real. Let's break down exactly what happens and why is this rally real? Is a genuinely open question right now. So what actually happened? Well, on August 19, 2026, Treasury Secretary Scott Bessent announced the department would double its buybacks on long-dated government bonds. That's a technical sounding move with a real immediate effect. When the Treasury buys back its own long-term debt, it injects liquidity into the financial markets and pushes down long-term bond yields. Lower yield free up investor cash and increase appetite for riskier assets. Exactly the kind of environment that tends to send money flowing into crypto. That's exactly what happened, fast. The 30-year Treasury yield, which had just hit its highest level since 2007 at 5.34%, dropped roughly 10 basis points on the news. That was enough to trigger a violent short squeeze across crypto derivatives. Traders who bet heavily on prices falling got forced to buy back into their positions to cover losses, which pushed price up even further, which forced even more short sales to cover in a fast-moving feedback loop. The result, roughly $3.5 billion in leveraged short positions liquidated in 24 hours, marking crypto's 7th largest liquidation event on record. Total crypto market cap added about $280 billion in a single day, roughly $12 billion an hour for 24 hours straight. So, Bitcoin opened the week in the low 60,000s and briefly touched nearly $80,000 before settling back to around $75,000 to $77,000 as of the recording of this video. Its best 5-day performance since March 2024, up roughly 20% for the week. Ethereum climbed over 25% for the week, trading around $2,400. XRP was a standout performer, up nearly 30% for the week and breaking back above $1.4 for the first time in months, with some analysts pointing to a regulatory backdrop that looked increasingly favorable to XRP specifically. Solana gained close to 20% for the week up to approaching its 200-day moving average. The institutional flow data backs up that this wasn't purely a derivative story. Spot Bitcoin ETFs pulled in $517 million on August 19 alone, their largest single-day inflows since early May, while Spot Ether ETF took in $189 million, their biggest since October of 2025. By Thursday, combined Bitcoin on Ether ETF inflows for the day exceeded $800 million, with every listed crypto assets, including XRP and Solana funds, drawing in fresh money, a second straight day of accelerating institutional buying. So, the bull case and why this might actually be a genuine turning point. And a few analysts are treating this as more than a one-day squeeze. Bernstein specifically pointed to the Treasury expanded buyback program as a real structural liquidity catalyst, not a gimmick, but an actual policy tool that's now working in crypto's favor. One trading desk noted Bitcoin's reclaiming its 200-week moving average as a meaningful technical signal, strengthening the broader setup beyond just the squeeze itself. Breadth is the other bullish argument worth taking seriously. Bitcoin forks, a small highly speculative corner of the market, surged 39.5% over the week, one of the best performing categories of the entire rally. When capital flows into the most speculative, least institutional part of the market like that, it's traditionally read as a sign traders believe the rally has real legs rather than being a narrow defensive bounce concentrated only on Bitcoin. In a weak rally, Bitcoin usually just sucks liquidity away from everything else. This time, however, nearly everything rose together. MEXC research specifically pushed back on the bullish framing, arguing markets were giving Bessent's intervention too much credit and calling the rally premature. There's real data supporting that skepticism. The 30-year Treasury yield, which dropped on the initial announcement, had already regained most of that decline within 24 hours. The exact liquidity tailwind driving the bull case had partially reversed almost immediately. There's also a real macro tension sitting underneath the rally that's easy to miss if you're only looking at the crypto prices. The 2-year Treasury yield, which is directly sensitive to the Federal Reserve's policy expectation, jumped meaningfully the same week, and CME Fed Watch data now shows the probability of a Fed rate hike in September climbing above 40%, up from just 33% a week earlier, with the odds of at least one hike sometimes in 2026 now sitting at 72%. That's a genuinely hawkish signal running in the exact opposite direction of what a sustained crypto rally usually needs. One trading desk specifically flagged momentum indicators as deeply overbought on shortened time frames, with implied volatility rising towards 40, a setup that often precedes bigger swings and potential consolidation, not necessarily continued upside. So what happens next? Well, here's the honest current answer, and it's genuinely unresolved. Whether this was a real liquidity turning point and an amplified one-week short squeeze comes down to what happens over roughly the next 2 weeks, and analysts have pointed to specific checkable signals rather than fake sentiments, so make sure to note this down. First, ETF flow data is the clearest one. If spot Bitcoin and Ether ETF inflow stays above $1 billion weekly, that suggests the rally has an actual institutional foundation building underneath it. If those flows drop off sharply from here, it's likely meant that the squeeze had already priced in most of the good news and the rest was leverage unwinding rather than fresh conviction. Bitcoin holding above $70,000 is this other level several analysts are watching specifically. A genuine hold above that level would suggest the move can outlast this week's historical squeeze. A fallback below it would support the more skeptical reading. And two scheduled events sits directly in the path of this question: the August 26 PCE inflation print and the following Fed meeting in September, both capable of either reinforcing or completely undercutting the rate cut adjacent optimism currently back into the crypto prices. So this week's move is the real in the sense that the money genuinely moved. 3.5 billion in liquidation, 280 billion added in market cap, and hundreds of millions in fresh ETH inflows aren't fake numbers. But real and sustainables are different questions, and right now serious analysts are giving you both answers depending on who you ask. The most honest way to think about isn't picking a side today. It's watching the two concrete signals that actually answered it: whether ETF inflows keep pace above that $1 billion weekly threshold, and whether Bitcoin actually holds above this $70,000 once the initial squeeze energy burns off. Also, if you want to have less burden in timing the market, then just DCA or dollar cost average, because it's usually at the end of the bear market years, the Q4, it's usually where Bitcoin actually bottoms. But obviously, it's not financial advice. If you want more on topics like this, make sure to check out my other videos. And stay safe, guys. Stay curious, and I'll see you guys next time.